Everybody, for your note term of the day, today's term is, what is UPB? Now, UPB is probably one of the most important terms in the note business because it's a little bit different than a lot of the other acronyms that real estate investors use. Most people are familiar with FMV, like fair market value, or BPO for broker price opinion, or CMA for comparative market analysis. What most people don't understand in the note business, UPB stands for unpaid principal balance. That's right, unpaid principal balance. That's where the UPB comes for. And we as note investors, that's the amount that we're actually able to collect on. Now let's give you an example. Literally, the definition as it reads, unpaid principal balance, UPB, is the portion of a loan, mortgage note, to basically say, at a certain point in time that has not yet been remitted to the lender, has not been paid off yet. Okay. For a typical consumer loan, such as a home mortgage or an automobile loan, the original unpaid principal balance is the amount borrowed and therefore the amount the borrower owes the lender on the origination date of the loan. So if somebody takes out a $100,000 loan, the UPB is $100,000 at the day they take it out. Now, the unpaid principal balance will decrease as time goes on for the loans that are structured with level payments. If it's an interest-only loan where they're only paying interest each month, that UPB will not go down. But in a traditional 30-year, 15-year, 40-year amortization, the principal and interest payment is interest plus a portion of principal, a small amount, but still something. So for these common loans, each monthly payment includes both interest and principal. The unpaid principal balance at the beginning of a given month is reduced by that portion of the level payment that is designated principal for that month, so that the unpaid principal balance at the end of the month is the beginning UPB less the principal amount paid for the month before. Hence, the unpaid principal balance reduces over time. And we as note investors, that's one of the first columns we look at, is what's owed, the UPB. Now, the UPB is not the payoff amount. A lot of people get confused. Oh, is this the payoff, or is in other cases the legal amount? No, the payoff amount or the legal amount is the unpaid balance plus any back payments not made, any late fees, legal fees, insurance, whatever it might be, taxes that's paid, anything's been paid on behalf of the borrower. That would be the payoff. But the unpaid principal balance is just exactly the same. It's the unpaid principal amount of the loan, not late fees, not late payments. We literally look at that number and then we compare that number to the fair market value of the property, the as-is value of the property, the FMV, seeing if there is equity or no equity. If there is equity, then oftentimes we'll take the legal balance or the payoff amount and look at that number and make sure the borrower owes more on the property than what it's worth. Now, if there is a lot of equity, we'll go into a different calculation for that. But unpaid principal balance, you'll hear that throughout the note industry. It's one of the most important terms, and UPB is something that you'll see. Now, we don't look at ARV, after repair value. We're looking in the note business at exactly what the borrower owes as far as the principal amount of the loan. In some cases, you'll see loan amounts where the UPB bank and the payoff is going to be obviously a whole lot more than the UPB. That usually shows that the borrower hasn't made any payments or is late by months or years in some cases. But UPB, really the number one term that we see in the note business.